committee continues to judge that the first increase in the federal funds rate will be appropriate when it is seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium
So
term.
no rate increase again. This was a meeting that we used to have high expectations for. You know, it wasn't that long ago that this could have been the meeting where the Fed finally lifts off from zero for the first time since, well, a long time. And with me here is Cardiff Garcia from FT Alphaville to discuss, you know, what went down today. So in the end, it was kind of a boring meeting, wasn't it?
This was one of the least eventful, most boring Fed meetings I can remember, and that is saying something, okay? Look, Janet Yellen wants to preserve her flexibility above all. She emphasized again and again that they're going to be data dependent. She also emphasized quite a bit that the date of the first rate rise doesn't matter so much as the expected path of subsequent rate rises. This is a theme she's been hammering on for some time. She's clearly trying to get the markets to not overreact to the first rate rise, which I think most people still think will probably now be in September. But as you said a minute ago, it wasn't that long ago that we thought it might happen in June. So this kind of thing tends to fluctuate, and she wanted to preserve the option of letting it be delayed again.
Yeah, and she kept saying gradual, 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 gradual.
Yeah.
It was everywhere. It was all over the statement, it was all over the press conference. I mean, and they did lower the dots as well. I mean, do you think that we might see a further lowering of the dots of the path of where interest rates and how quickly they're going to go up next year and the year after that?
Yeah, I mean, what's interesting about this is that this is related to maybe her very first communications innovation as chair last year, when she said that even as unemployment and inflation get back to levels that are sort of consistent with the Fed's mandate, that even then the path of the federal funds rate might remain below what they would consider to be normal, you know, given where unemployment and inflation are. And I think it's interesting that the dots once again reflected that it's going to take a very slightly shallower path than we were thinking even at the March meeting. So, you know, it could just be that they're trying to communicate that, look, we recognize that the first quarter wasn't great. We recognize that potential GDP growth, not just what GDP growth does in the near future, but the potential might be lower than we think it is. And if that's the case, then it also means that, you know, correspondingly, that the path of rates might also have to be lower. So it probably wasn't a big enough change to make too big a deal of it, but this has been happening, you know, for some time now, so definitely worth watching, yeah.
But even the whiff of slightly lower for longer, or even lower for longer, was great for markets. They had a complete party. And even during the press conference, you know, Yellen didn't exactly put an end to it by sort of having any sort of hint that September might be the final liftoff date. I mean, do you think, are we talking about December, even 2016? She said she wants to hike, or considers hiking 2015 as a central scenario. But do you think, are we looking at 2016 now?
Hard to say, I mean, because let's also keep in mind that I think 15 of the people on the FOMC still believe that it's going to happen this year. So that still seems like the most likely scenario. Obviously, it depends. If we end up getting a few straight bad labor market reports, if GDP growth is weak once again, I mean, right now it seems as if the first quarter really was an anomaly, but you never know with these things. If it does start to change, then the Fed might adapt, and I think they've shown a willingness to do that, and certainly Yellen, and she said this in the presser, is worried that if they lift off too soon, that they risk derailing a recovery that's taken so long to get to where it is now. So I wouldn't be shocked, but still I think the most likely outcome is still a September or certainly a December liftoff. If not, then I think it would take a real, you know, I don't want to say derailment, that's a strong word, but it would take a few bad labor market reports, maybe even inflation remaining where it is now, staying lower, not starting to move back towards 2% as they anticipate.
My colleagues and I would like to see more decisive evidence that a moderate pace of economic growth will be sustained.
The long-term forecast didn't really change that much, the dot plot. It does seem to still indicate that, you know, we're going to go towards sort of a long-term, you know, Fed funds rate of 4%. But the market still seem to believe this kind of new normal of the Fed funds rate ending up at sort of 2-3%, really.
Yeah.
I mean, does that have a bit of potential to scare the bejesus out of people at some point?
I mean, there's a sort of a clear divergence there, and that's one of those issues where the divergence is big enough that they can't both be right, okay? they might both be half right and half wrong, and there'll be something in the middle in between those two things, but they can't both be right. And so at some point, either the Fed will have to acknowledge that we are in either a new normal, that maybe potential growth isn't as big as it used to be, and so the path of rates will have to adjust to a lower level, or the markets will essentially, have to admit or acknowledge the fact that actually, yeah, growth is fine, and we can get back to sort of a pre-crisis trend, and then they'll adjust their own forecast. So it's really kind of hard to say right now. That's one of those kind of open questions of secular stagnation and all these other kinds of things we've been discussing for a while, and which only the future can answer, really.
Yeah. Well, so far markets seem to have been getting the path more accurately than the Fed itself has.
Yep.
But I think it'll be pretty ropey goings for the markets if the markets do prove out to be wrong on the long-term picture here, that we are going to be moving back to a Fed funds rate of 3-4%.
Yeah, and what's interesting too is, Janet Yellen said essentially we can't guarantee that there won't be any volatility if the markets get what we do wrong. All we can do is try to communicate as clearly as possible what we're thinking at any given time. I actually don't think the Fed is going to be all that worried about volatility going forward. Just like Draghi said not long ago that we should all get ready for a period of higher volatility. I think the Fed would actually be okay with that, a little bit of markets volatility, so long as it doesn't, again, derail the kind of progress in the real economy that they're hoping for.
Yeah, a bit of a sort of a Goldilocks tantrum where maybe some of the froth gets wiped out, people learn to fear the Fed, and maybe start pricing risk appropriately, but not so much that we have a sort of derailed economic or 1937 style correction, I guess.
And let's keep in mind also that the Fed has its two primary mandates, okay? Stable inflation, low unemployment, all right, or full employment, to be more specific, all right? Everything else is important. They factor it into what they do, but it's secondary. It's a secondary issue, and that's, I think, something to keep in mind. It doesn't have a monetary policy mandate for financial stability. Financial stability can matter if it's going to take the Fed away from its two mandated goals, but it's not the primary objective here. They have to stay focused on inflation and unemployment.
Oh, stay focused, stay the course. Well, Cardiff, thank you so much for being here.
Always a pleasure.
No, thank you.